Arthur Laffer is about to get the Presidential Medal of Freedom. What if the theory that got him there is completely wrong? I'm Scott Ott with Bill Whittle and Stephen Green, and this episode of Right Angle is brought to you by the members at BillWhittle.com. And gentlemen, the National Public Radio's website has a story about Arthur Laffer during the week when he's slated to receive from President Trump this Medal of Freedom, in large part due to his contributions as an economist, proposing what's become familiarly known as the Laffer Curve, this idea that at a certain point, if you cut the tax rate, you will increase productivity and therefore increase receipts to the Treasury. And so there's this sort of bell curve of when that happens. And if you can get that in balance, you'll get more revenue by charging a lower tax rate. And I'll let Stephen Green go into more detail about that in a minute. But National Public Radio took this opportunity to trot out some old wise men like David Stockman, former manager of the Office of Management and Budget, or director rather, under the Reagan administration, Bruce Bartlett, who also worked in the Reagan administration, and others. And basically NPR said, no Republican economists think that the Laffer curve really works. And in fact, if it does work, it only works at a much higher threshold level than the current corporate tax rate. And so, in effect, it doesn't matter if it works. They point out that Arthur Laffer was paid $75,000 by the state of Kansas to come in there and help them to cut their taxes, and that failed as well. They say Kansas had to increase taxes. They say that Reagan had to increase taxes after initially cutting them because the revenues actually fell. Stephen Green, you indicated during our backstage meeting that you think people misunderstand the idea of the Laffer curve. I wonder if you could elucidate on that a little bit. And then tell me if you think that Republicans should let go of this pipe dream of cutting taxes to increase revenue.
Well, yeah, see, that's the thing. What Laffer said is, if you've got this bell curve, and let's you briefly describe, but what that bell curve is at a 0% tax rate, you collect $0 in revenue. At a 100% tax rate, you collect $0 in revenue because you've driven all economic activity either out of existence or underground. So somewhere on that curve, you have a tax rate that maximizes the revenue that you can actually collect. Because if you raise taxes too high, people either stop doing things or they stop doing things where the tax man can see them. And that's where it gets complicated, because in practice, it's not a point on a curve. The curve shifts and moves according to what the economy is doing. There are headwinds, there can be tailwinds, and which change the shape of the curve. There are things that it fails to take into consideration because they're outside of the scope of what Laffer was trying to talk about, which is the fact, back in the 1950s, we had this top marginal tax rate of, what was it, 90% or something, but nobody paid it. Not one single person. Actually, I think they proved that in the early 60s, there were 8 families paying the top marginal tax rate, and only because they were idiots with terrible accountants who inherited their money and they didn't care.
My family was one of them, certainly.
Certainly, right? And so there are all kinds of things that just don't get taken into consideration. That said, there is a wonderful case for low taxes, and it was so horribly made by one of my actually probably my favorite peacetime president, and that's Calvin Coolidge. It's one of the earliest examples you'll see, it may be the earliest example you'll see, of a president on film with sound. And he's just standing there very stiff, like he's posing for an old-time photograph, right? Where you had to hold still for 10 seconds. And he's looking down, reading off these cards, but the words he's saying are kind of magical because they're so common sense. He's saying, you have to pay tax before you buy food for your children. You have to pay tax before you pay the rent or the mortgage on your house. You have to pay tax before you can buy an automobile to get you to work. You have to pay tax before you can buy anything. One thing, and that there is the argument for low taxes. It's not because some magical point on a curve where we can maximize this and minimize that. It's because taxes are a burden. They're a burden on workers. They're a burden on employees. They're a burden on employers. They're a burden on every single thing you want to do, because everything you want to do, except for thingy, is taxed. It's a burden. Let's reduce it.
Bill Whittle, I think Steve points out something that, I thought before we came on for this show is that there are other good reasons to have low tax rates. And he's done a good job of explaining that. But I think there's also an aspect of this, and Steve hinted at this as well, is that there are many variables in this process. And so the tax rate in isolation by itself doesn't guarantee higher revenues to the government. But Bill, right now, during the Trump administration, when we have cut the corporate tax rate down to the low 20s, and during the Reagan administration, when they also cut the tax rate, in both cases, the spending was not cut. And in fact, spending was increased. And so Bruce Bartlett and David Stockman and others have basically said, why are Republicans they're using the Laffer Curve as an excuse to continue to spend like madmen instead of realizing that the basics of economics, which is that, if you cut taxes, you can also cut spending. And if you cut spending, you're probably doing as much, if not more, for the benefit of the country than if you just cut taxes.
Well, you mentioned in our backstage show that that the NPR crowd said that the Laffer Curve didn't make much sense. It was not really, you couldn't really understand it. So,
well, it's not that they couldn't understand it; it's that it doesn't work.
Okay, well, let's just review what the essence of the Laffer Curve is. The Laffer Curve says it is better to take 10% of a pizza the size of this room than to take 25% of a pizza the size of a plate. There's more pizza there. So it's basically saying that you can take a smaller piece of a bigger pie and get more pie. That's basically how it works. To say that it doesn't work is a little bit ironic, especially since Barack Obama said just a few years ago, there's no magic button I can push to make the economy grow at 1% or higher. Yeah, there turns out there is. It's a button you can push, and the button is lower taxes, and we've gone from 6.6% economic growth to 3.5%, 4%. Everybody's got more money. Record unemployment lows for blacks, women, and so on. It's right in front of our faces. So the whole thing is an exercise in just plain duplicity and meanness.
Well, Bill, in fairness to them, they're not dealing with that aspect of it, though, because what they're saying is that the revenues do not increase to the government sufficient to cover the cost of running the government. They're not denying that there are some beneficial effects in the economy, like more people have jobs.
Here's the point. And it's a real simple point to understand. This point is so simple, I think even progressives could understand this.
Good luck.
Take it away. Take away taxes. Take away Laffer. Take away all this stuff. The Laffer Curve is in place at every single level of everything we do every single day. It's everywhere. And I will give you a simple example. Let's say that you're Nike and you want to sell shoes and you want to make as much money as possible selling those shoes. So you have a pair of top-end Nikes. Now, you could sell those top-end Nikes for $1 each, and you'd sell a lot more Nikes, but probably wouldn't even cover the cost. So let's say we sold them at $20. At $20, those shoes would sell an awful lot more, but you wouldn't be making much profit on them. Let's go the other way. Let's say that the shoes were going to cost $2,000. Yes, there are some people who could pay $2,000 for Nike shoes, and they'd make more money per set of shoes, but that would not be the most money they could make. The most money they could make is to find that sweet spot. It's different for every single product. It's different for every single product. But what there is for every product on the market is a price below which you will make less money by selling more of them at a lower profit, and above which you will make less money by selling fewer of them at a greater profit. That is the Laffer Curve in action every single day, everywhere. And in the free market, we get to determine that by our individual our decisions. If I don't want to pay $250 for a pair of shoes, but I might pay $100 for a pair of shoes, that tends to drive the price down, and it finds itself. So to say that this thing is doesn't work is insane. It's just simply insane. Forget about all the evidence that has come up from Donald Trump cutting the tax rates. It absolutely works. It works on NPR commentators' salaries. NPR is governed by the Laffer Curve every single day. They have a certain number of employees that they pay. If they paid more employees, they would make less money. If they paid fewer employees, they'd make more money but get less work done. It's a law of nature.
Now, Bill, in our backstage meeting, you indicated that you think that Arthur Laffer deserves to be recognized
just going there.
in the naming of a... Go ahead.
Yeah, I think that Interstate 10 running from Santa Monica to, let's say, Houston, or no, let's go all the way to, what's that town on the eastern border? Is it Beaumont? I think Beaumont, Texas. Okay, so let's take Interstate 10 from Santa Monica, California to Beaumont, Texas. This ought to be called the Arthur Laffer National Highway. And the reason it should be called the National Highway is because Interstate 10 from California to Texas is essentially a one-way street. It's essentially a one-way street. People are leaving California and going to Texas only because of the Laffer Curve, only because of the Laffer Curve, because Texas has the sense to understand that by lowering the tax rate, they increase economic activity so much that the state does better. And for God's sakes, not only does the state do better, the people do better. Last thing to say is this. Imagine two worlds where the federal government is going to take in $1 million, make it $1 billion, make it a gazillion. Let's make it modern. We need $100 trillion in revenue. Okay? In one world, we have low taxes where the economy is growing so big that $100 trillion is a relatively small piece. In another world, it's a very, very big piece of taxation. We're taxing people hard for that $100 trillion. Now, which one of those worlds would you rather live in? If the revenues are exactly the same, if they're precisely the same revenues coming in, isn't every single person better off in the low tax environment? Everybody has more money to spend. Everybody has more freedom to decide what they want to do. Everybody's living a better life. This is such a simple argument. It's kind of a shame that people like this are making it as adults. Makes me want to go to NPR sometimes and just, take a rolled up newspaper and grab them by the back of the neck and just kind of put their noses in it, and just where they made this mistake, it's like bad progressive, bad, 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 bad. And then take them outside and show them the real world, and hopefully they'll poop out there.
Well, I have a problem with the Laffer Curve. Two problems, actually. Number one is that people look at it as if it were some sort of tool that you can use to tweak the economy, when really it was a description of how the economy works, as Bill has just elucidated there. I just read a story this morning talking about a particular form of drug, I think that's used to treat early stage bladder cancer. The drug's in very short supply. You know why it's in very short supply? Because it's cheap and nobody wants to make it. So there's only one company that makes this drug, and they can't ramp up production of it enough. So they're producing about, I think they said something like 300,000 units of this drug a year, but the demand for it is really about 1 million. However, because it's only $150 a dose, it's not worth getting into it. And the reason why that sounds like a lot of money to us, but not a lot of money to a drug manufacturer, is because this drug is produced by growing it on potatoes. And a very slight degree of contamination in the potato farm, so to speak, can cause an entire crop of this drug to be destroyed and unusable. And so there are fundamental economic forces that drive any economy. Arthur Laffer's curve was popularized in part by Jude Wanniski, an author who wrote a book that I'm about, I think, a third of the way through right now, called The Way the World Works. And Jude Wanniski said this concept is so primitive, you can think of it in terms of a baby crying, because a baby quickly figures out that there's a certain level of crying that will deliver attention appropriate to his needs, and that beyond that level of crying, he doesn't get satisfaction, and his parents become so annoyed by it that he actually may wind up getting less attention. And so there's a curve there for everything on earth. So first of all, it is a description, not necessarily a prescription that says tune this in this direction. Secondly, I don't think that Republicans should be about the idea of how can we fine-tune the tax code to maximize the income to the government. I think that is a fundamental error in conservative thinking right now. The way the tax code should operate in Republican minds is, what is the absolute minimum necessary money required in order to do the absolute minimum necessary functions within the scope of those delineated in the Constitution? No more. We shouldn't be about manipulating the tax code in order to produce certain outcomes. Let's try to get people to buy more houses. Let's try to get people to rent more houses. Let's try to get people to buy cars or to keep cars longer. Let's destroy all the cars that are in the used market. All of these are attempts to be the Wizard of Oz behind the curtain, pulling the levers and turning the knobs and making things happen. And that is, to paraphrase Jude Wanniski, that's not the way the world works. And so Republicans can make a case for lower taxes, although I think they never really know what that number is that they want. But they can make a case based on the idea of we need a smaller government. Why do we need a smaller government? Because we need more liberty. We need the pursuit of happiness maximized. And that's what we're all about, not tweaking the tax code so that we can manipulate the revenue to the U.S. Treasury. For Bill Whittle and Stephen Green, I'm Scott Ott. Thanks to the members at BillWhittle.com for making Right Angle possible.